Welcome to my channel. I'm Scott, and in this video we're going to talk about stock splits. I'm going to first give you a really simple example on how to understand what a stock split is. This is a fake example. It probably wouldn't happen in real life, but it's a great way to convey how stock splits work. Say you're a part owner in Jimmy's sub shop. You own half the company, Jimmy owns half the company. There's two shares. Your share is worth $50,000. Jimmy's share is worth $50,000. Jimmy decides to do a 2-for-1 stock split. Now you own two shares of the company, and each share is $25,000 each. So nothing changed. You still own half the company. Why would Jimmy do this? Why would he do a 2-for-1 stock split? Well, before the stock split, you couldn't sell your share of the company unless you wanted to get out entirely. Now, after the split, you have two shares, so you can sell off one share and still keep part of the company. So as you can see, stock splits don't affect valuation at all. They only affect the number of shares. So in both examples, you have the same piece of the pie. So before the split, you had 1 out of 2 pieces. After the split, you have 2 out of 4 pieces. But you still own 50% of the company in either situation. Now let's do a real world example. In July of this year, Alphabet did a 20-for-1 stock split. So if you own one share before the split, you would have owned about $2,200 of Google. After the split, you now own 20 shares of the company, but each share is $110, so you still own $2,200 worth of Google. That's a key thing to remember. The valuation does not change with a stock split. Valuation equals market cap, and market cap equals shares outstanding times stock price. How are dividends affected with a stock split? Well, let's just say company X did a 2-for-1 stock split. Before the split, the stock was trading at $100. After the split, it's trading at $50. So before the split, each shareholder received $1 per quarter. So let's calculate the yield. You first have to annualize the dividend. There's 4 quarters in a year, so 4 times 1 over the share price. So $4 over $100. The dividend yield is 4%. After the stock split, each shareholder will receive 50 cents a share. So 50 cents times 4 quarters over $50. $2 over $50. The yield is still 4%. So the dividend isn't affected with a stock split. A company can raise or cut their dividend at any time. And if the stock price goes up a lot for some reason after the split, then the dividend yield would decrease. Or if the stock price went down a lot after the split, the dividend yield would increase. How is earnings per share affected? Because the number of shares changes with a stock split. To calculate EPS, earnings per share, it's net income over shares outstanding. Sometimes you have to get used to the lingo in finance, but earnings is the same as net income, which is the same as profit or net profit. It's just all different ways to say the same thing. So EPS tells us how much profit or loss a company makes for each share of stock. This is a really popular metric for estimating the value of a company. It's similar to the PE ratio. PE is stock price over earnings per share. So if you're invested in a company, you would hope their EPS increases. But you always want to compare these metrics to similar companies and compare to the same company over time. I'll show you how the EPS would change with a stock split. Say company X had an EPS of $10 before a 2-for-1 split. Then it will be $5 after the split. That doesn't mean the company's value is cut in half. So to calculate the EPS before the stock split, the company's net income will be $1 billion. When you calculate EPS, you want to take net income over a 12-month period. And net income is not affected by a stock split. And now you need the shares outstanding. Say they had 100 million shares outstanding. So to calculate EPS, it's 1 billion over 100 million. And that equals $10. So your theoretical portion of the net income is $10 if you own one share. Before the split, the shares traded at $100. After the split, net income is still 1 billion, but the shares doubled to 200 million. So the EPS dropped in half to $5. And the return is the same because a share of stock is $50. Your portion of the net income is $5. That's a 10% return. So when a company does a stock split, all the metrics are split adjusted. So if you looked at the company's EPS over a long period of time, say 10 or 20 years, it would appear their EPS before the split was $5, even though it was $10, because all their numbers have to be split adjusted so the charts read correctly. So let's talk about a reverse stock split. When you see a 2-for-1 stock split, that means if you have 1 share pre-split, you would have 2 shares post-split. The number of shares increases. When the first number is larger than the second number, that's a regular stock split. If the first number is smaller than the second number, that's a reverse stock split. So a 1-for-2 stock split means if you hold 2 shares pre-split, you'll have 1 share post-split. The number of shares decreases. But if a company does a regular stock split, say a 10-for-1, you may see an article saying they did a 10-for-1 stock split. But if a company does a 1-for-10 reverse stock split, almost any article will use the word reverse. It probably won't say a 1-for-10 stock split. But if it does say a 1-for-10 stock split, that means it's a reverse. So let me give you an example. Say company X does a 1-for-5 reverse stock split. Before the split, you own 50 shares and each share is 50 cents each. So your value of company X is $25. After the split, you now have 10 shares at $2.50 per share. So your valuation of company X is still $25. You see your total shares was divided by 5, but each share price went up by 5x. When a company does a reverse stock split, it's usually a sign of a company in distress. Most reverse stock splits are done to avoid being delisted. For example, the NASDAQ may delist a stock that is consistently trading below $1 a share. When a company gets delisted, it doesn't mean they've gone bankrupt. You could still be a profitable company and be delisted. The thing is, when a company trades on the OTC pink sheets, there's less liquidity, less trading activity. So the stock price probably won't appreciate as much as being traded on the NASDAQ or New York Stock Exchange. If you're a Canadian company trading on the TSX, which is a major stock exchange, and you get delisted, you may go to the CSE, Canadian Stock Exchange. Most regular investors like me and you don't trade OTC, but most companies aren't too concerned with people like me and you. They're more concerned with big institutions like JP Morgan or Goldman Sachs, or mutual funds or pension funds, because those types of entities have rules in place. If a stock is trading below a certain dollar amount, say $5, then nobody at that company can buy the stock. When you fall off the radar of these big funds, then your stock price probably won't appreciate much, because it's these big investors that buy huge blocks of companies, like $10 million or $50 million worth of a company at a time. But you could be trading below $5, you could be $3 a share and still be a much bigger company than a company trading at $8 a share. You could be trading at $1 a share and have a market cap 10 times the size of a company trading at $10 per share. You could even be a really profitable company trading at 50 cents a share, and you could be a really struggling company trading at $1,000 a share. Stock price is really meaningless. It's the value of the company, the market cap. And it could make it really difficult to look at price charts with reverse splits. This company ship, Synergy Maritime, they're a marine dry bulk transportation company. They ship things like coal or grain. And they've done so many reverse stock splits, it looks like they were trading at $175,000 when they IPO'd. You cannot trade at that price when you IPO. You could trade at that price if you've been in business for many years and you've grown like Berkshire Hathaway. If you ever see a stock price over a few $100s a share at IPO, it's almost always due to a reverse stock split. And if you're invested in leveraged funds, like double, triple, quadruple leveraged funds, because there's tons of decay risk, and over time, the stock price pretty much always goes down for those investments. In a short period of time, anything can happen, but over a long time frame, they pretty much all go down. So if you look at this chart, you really can't tell if the stock price went up or down since 2019. It looks flat because the numbers are so big back here. You can't really tell what the stock has done the past few years. But now let's just look at the chart since 2019. You can see it was $150 a share in 2019. Now it's down to below 50 cents. And we know that's because of reverse stock splits. And there's lots of people that make this mistake. I made it at one point, and I've gotten comments on my channel saying you gotta hold this stock because it was trading at $150 3 years ago, and now it's below $1. We're gonna be rich if the stock just gets to $10. And I try to tell those people the stock wasn't trading even close to $150 in 2019. I think it peaked at about $5 or $6. And these people think I'm stupid because I can't read a stock chart because it obviously says 150. But if you don't understand how reverse stock splits work, you'll never understand how to read these charts. But a profitable, healthy company over a long period of time might have a stock price chart that looks like this. This is Google's. It looks like that price was really low for a long time and then it shot up. And the reason it looks like this is because of regular stock splits. They did a 2-for-1 stock split in 2014. Then they did a 10,027,455 to 10 million stock split in 2015. But the real big stock split was in 2022, a 20-for-1. And I always hear people making this mistake, saying things like, at one point, Google was a penny stock and Microsoft was a penny stock. And I tell them Google was never a penny stock. Just because it looks like it was trading at $2, $3 when it IPO'd doesn't mean it's a penny stock. It probably IPO'd at $20, $30 like most companies do, but it was never trading at $2, $3. Because if you owned Google in the beginning of this year, it was over $2,000 a share. And the stock price never traded over 150 according to this chart. Because once they did a 20-for-1 stock split, they had to divide all the previous stock prices by 20 so the chart would make sense. And some companies are profitable and grow, but they don't do stock splits. Look at Chipotle. The stock price is over $1,000. And they're not a small company. They're a mid-sized company, 43 billion market cap. And I see sometimes people make the mistake of saying, oh my God, Chipotle is worth 5 times as much as Microsoft. $1,300 a share. Microsoft is only $240. But actually, Chipotle's market cap is a rounding error for Microsoft. Their market cap is minuscule compared to Microsoft's market cap. So always remember, market cap is the value of a company, not stock price. And the reason Berkshire Hathaway's stock price is over $400,000, it was over $500,000 at its peak, is because they never did a stock split. Microsoft is much bigger than Berkshire Hathaway. Microsoft is 3 times the size of Berkshire. And Berkshire is one of the largest companies in the world. The reason a share of Microsoft is lower is because Microsoft did lots of stock splits. If Microsoft wanted to, they could have had a stock price more than Berkshire Hathaway. In the past, Warren Buffett said the reason he didn't want to do a stock split, he wanted to make his company exclusive. Only people who really wanted to own the company and not sell it could buy it. But that kind of changed when Buffett came out with the B shares, which were much more affordable than the A shares. And now some websites sell fractional shares. So anybody can buy any stock with just a few dollars. So to summarize, the main reason companies do stock splits is to make the stock price more affordable. A lower price increases the number of people that can afford the stock. So even if you can afford to buy 1 share of Google at $2,200, psychologically, people don't like owning 1 share of stock. It feels like they don't own much of the company. They much rather have 20 shares at 110 than 1 share at 2,200, even though your value is the same. But like I said earlier, with fractional shares, it's a moot point. You know, a moot point, like a cow's opinion. It doesn't matter. So a company's market cap can go up or down following a stock split. There's no indication the company's valuation should go up because it does a stock split. It could go up after a stock split. Maybe the company's really undervalued for a while and coincidentally, people started buying the stock after the split. Or it could go down a lot after a stock split. It could be in the middle of a bear market. But I think a reverse stock split will probably result in a company lowering its market cap. Also, when a company does a reverse stock split, the price per share goes up a lot. So if you wanted to short a company that was trading at 50 cents, there's really not much room to short it. But the stock price went up to $5, now there's more room to make money on a short. And a company can do any quantity stock split. They could do a 3 for 1, a 3 for 2, 100 for 1, 1,000 for 999. Same thing with a reverse stock split. They could do a 1 for 2, a 2 for 3, an 80 for 81. Really any combination they want. So I hope you learned something new in this video. Please leave a like, a comment, subscribe. Thanks for watching.